climate risk resilience and ESG integration with capital programs. An experienced professional with 15 plus years delivering risk avoidance strategies. With the transition to a low carbon economy, the ability of an organization to decarbonize its operation is often a material climate risk, which can also provide opportunity. Jason has supported organizations to quantify this specific risk and others, including physical risk to transport infrastructure. He has led a multitude of projects to the world's largest asset-intensive companies across a wide range of industries, including power and utilities, oil, gas, and chemicals, mining and metals, pharmaceutical, and food packaging. Jason joined KPMG in 2021 and is based in Austin, Texas. And what Jason will do is help us focus on the specifics of the SEC proposal and its specific content. Jason, thank you so very much.
So, interesting comment from Brad about the Big Four hiring ESG people. So, I joined in 2021, and our climate advisory team, which is separate from our audit and accounting teams, but our climate advisory team had 10 people in it. As I stand here today, we have 80 people in our climate advisory team. So in the 18 months or so that I've been with KPMG, we've gone from 10 to 80 just in climate advisory. The other thing that's interesting here as I kind of roll into this is I'm an engineer. I don't come from an accounting and finance background, and previous to the SEC rule coming out in March, I probably never even spoke to the accounting teams. Certainly never spoke to the internal audit teams. We were just doing our thing within climate advisory, helping organizations to develop strategies for how they would decarbonize their assets, their organizations, how they would understand the risks, and also how they would understand the opportunities. And that's really what we have to think about. Being the person that always talks about risk, it's pretty easy to talk about the hurricanes and the floods and the sea level rise and all the different regulation that we're going to see. We really need to look at the opportunity within that, and that really became no more evident to me than when I presented to my daughter's first grade class. How do you present climate change to a group of first graders? You can't talk about all the scary things that I just mentioned. You have to talk about what are the opportunities and what can we all do and how can we all look at what are the opportunities for us moving forward in order to help our organizations be more successful as we transition to the lower carbon economy, or even prepare for whatever future we may see in terms of being more resilient in the infrastructure that we build and the strategies that we have within our organizations. So I'm going to talk today a little bit about the SEC rule. We're going to dive into that in a little bit of detail. But at the same time, keep in mind that I'm an engineer who looks at climate risk. And I work very closely with our accounting teams who really get into a lot of the details here. So this presentation will certainly be SEC rule with a spin and a focus on how do we understand climate risk and how do we do some of the things that the rule is asking for, like quantify what are the risks of an event that maybe hasn't even yet been defined. How do we determine some of those things? So with that, we can dive in a little bit and get started here. So first thing we're going to look at is what the proposal, it sounds like you're all familiar with the proposal. March this year, they released their proposed climate rules. That proposal had over 500 pages. Breaking that down, it had 119 new unique disclosures that organizations were going to have to try and figure out how to address. So extremely complex, extremely comprehensive set of potential disclosures that companies are looking at. These disclosures were broad in terms of the parts of the organization that now needed to be involved to try and understand what was in this particular rule. And that's when I got connected with the accounting teams, because they said, how do you do all this risk stuff? How do you determine what are the risks for an event that's going to happen out in 2030, out in 2050? Most companies are planning for their long-term plans are 5 years out, and now we're having to really stretch that and getting to push all the way out to 2050 in most cases although we do have the ability to look out to 2100, and that may seem like a long way away, but my daughter will likely be alive in 2100. It's not that far away. When you write it on a piece of paper and you write 2100, it looks like we're never going to get there. We don't have to worry about what's going to happen in 2100. But the fact is we do. I spent a couple of weeks ago, I was up in New York at the Climate Week, and throughout the week, the comment that kept being made over and over again is, this is the decisive decade. This is the decade we have to influence change, to make a change, and it's a decade like we've never seen in history in terms of the change that will occur, and I think Tom spoke to that very well at the beginning of this symposium. So why should companies care about this? They should care about this not only because it may become a required disclosure. It may become a reporting requirement that is mandatory. They need to care about this because it can potentially unlock value for the organization in terms of how they obtain capital, the strategies that they employ, the new products that they develop, the markets that they go into. They need to be thinking about how they unlock value, not just because there is a reporting requirement. That is really the end result of all of this, is the need to report, but there's a whole bunch of really interesting work and really important work that companies can do that leads up to that point of actually generating the financial line items in the 10K, developing the new section, developing the note. That's all formality after you understand what are the risks and opportunities, what are your emissions, how do you report on those, and what are opportunities going forward. So we can talk about some of the elements of the rule today, and really talk about how do we take this forward, and what are some of the challenges that we really still haven't solved. Even though we've potentially got this 500-page document that was intended to bring together our consistent, comparable, and reliable information to be able to enable us to report in a very transparent way, there's still some things we don't quite understand. Now, it is still in a proposed format, and please don't ask me when it's going to be released, but that's something that even I don't know the answer to when it's going to be released. All we can do is really cross our fingers and hope that it's soon. We understand that there will likely be litigation. We understand there will be changes. But of the 119 disclosures that are currently in there, we also don't expect it to be erased completely. We don't expect it to go to 5, 10, 20. There'll still be a significant amount of work required for organizations to be able to meet what the disclosure requirements are. So if we look at the rule itself, and we look at some of the areas that are kind of written in here, although I said we're going to focus on the climate risk, we can't ignore some of the other sections. We can't ignore how companies need to report on their emissions. Their scope 1, their scope 2, their scope 3 emissions, and what the timing of those emissions may be. Lots of discussion around scope 3. How do we do it? How do we do it? How do we get information from our suppliers that can hold up under an assurance or an audit? How do we do that when the data is not available today? That data comes from different systems. It's not reliable. I have to call somebody up to try and get that information, and I don't know what their processes are. So there is loads of challenges to ensuring that we address some of the areas within the rule itself. But a few of the important items here. So the first one, financial impact metrics. How do we understand at a financial line item how climate risks that have occurred in the past, have occurred in the last reporting period, how do we reflect those in our financial statements? At the same time, how do we determine what's material going forward? How do we determine what's material is the first question that needs to be asked, and then how do we go about quantifying those? We can look at the governance and risk management processes. The SEC looked towards the TCFD, which we heard earlier, and they used the term aligned with or aligned to the TCFD. About 60% of the SEC rule is aligned to TCFD disclosure. So these organizations that have been reporting on TCFD for years, and we heard that it's been in existence for 6 or 8 years, people have been starting to utilize this TCFD as a voluntary framework now have an advantage because they already understand a lot of this, already started doing this, but it was voluntary. It didn't fall under the same processes and controls that it now needs to when the finance team's involved. Sustainability used to be something the marketing team could develop and produce their glossy document. And that's changed and that's no more. And these two teams are now coming together and speaking at times for the very first time. And when we talk to the CFO, he is really concerned with the new rule. The general counsel is really concerned with the rule. You talk to the person in sustainability, they're like, we got this, we've been doing this for years. But they don't understand the level of process and control that all of a sudden is now going to come into play now that this needs to be part of your financial statements. There's another level altogether of what needs to be done. So governance and risk management, targets and goals and transition plans, scenario analysis, carbon offsets. Some of this is still, if required, is how it's written within the rule. If you're doing it, you need to disclose it in the effort to be transparent with what your organization's doing. The rule itself doesn't ask for any action. And that's really important to realize it. The rule doesn't ask for action. The rule just asks you to report and disclose what you are doing to enable an investor to understand what you're doing from a climate perspective, both in terms of how you're managing risks, how you're identifying those risks, how you're identifying opportunities, what are those opportunities, and what are your emissions and your transition plans in order to ensure that you are going to be able to meet some of your climate targets that you've set. So I talked to this a little bit, and as we look at what parts of an organization does this rule impact, it is almost the entirety of the organization. We have the Chief Sustainability Officer, so he's going to be involved, he's setting the targets. He's often the one that, up till now, has been involved in collecting all of the emissions information, somewhat likely in isolation. We have the corporate governance team, also now involved in making sure they have oversight in what gets reported. We have the data and technology team that everybody is now asking, what do we do? Where does our data come from? How can we put this on one platform? How can we report in a reliable way all these disparate data sources that we have that we previously hadn't needed to? And how do we do that in a timely fashion to enable us to produce this report on an annual basis? You ask an organization right now how long it takes them to write a sustainability report, how much effort goes into that, and it's months of work to put that sustainability report together. They're pulling hundreds of different metrics to tell their story of what goes into that sustainability report. Now we need to do it as part of financial reporting at our busiest time of the year for most organizations. We also have the policy, so the Chief Accounting Officer, so he's going to be involved. And then we have the process and controls, which we can't forget about the need for the process and controls over the information that we're now going to be reporting. Again, something we haven't needed to worry about too much in the sustainability world up until now. Now the one that's missing from this, and we actually updated the graphic here after we presented this to a client, is they said, where's risk management? Why isn't risk management there anywhere? Risk management, when we thought about it, really wraps around all of this. The existing enterprise risk management processes in place, they're in place, but not necessarily formalized to include climate risks. And how do we do that when our enterprise risk management process is set up on a 5 year as a long term? Do we change it? Do we have these risks that are out there for the next 20 or 30 years? And I asked this recently of enterprise risk management team, and their answer was really interesting. Their perspective on it is these risks are affecting us today. Although the time frame for them may be that they continue out for another 30 years, these risks are affecting us today, and if we don't start doing something today, we're going to be in trouble in terms of our business strategy and our ability to continue to generate revenue and continue to grow as an organization. So they're certainly plugged in and trying to figure this out. So I talked a little bit about the TCFD. My formatting's got messed up there. So a few things you can see on, we have aligned to TCFD for the most part. So we've talked about that. The need for increased transparency. So we touched on that companies need to prepare to disclose this information beyond what they're used to having to disclose. We have to talk about the experience on the board as it relates to climate risk. So we think about future opportunities. How many people like that exist in the world today? How many people exist that have deep climate experience that are at the level that could sit on a board? And there's probably not many that are going to need to fill all these board seats. So a huge amount of education is going to take place, and the next generation of board members will start filling some of those seats around climate and climate risk in general. We need to have transition plans and goals. We can't just set a target anymore. We need to actually have our plan of how we're going to get there. How much is it going to cost us to get there? What are we going to do to get there? And we see the transition plans that have been existing over the last 12 months depend a lot on new technologies that don't exist as their means to be able to achieve the goals. And that's going to start to be disclosed within these reports, that you're counting on new technology that doesn't exist to achieve your target. So therefore there's a risk associated with that technology may not develop fast enough, or it may be more expensive than you can afford as you look to implement it. And then because we're doing something different, looking forward in these statements, we need to protect some of the information in those. So we put these safe harbors in place to ensure that forward-looking information is not looked at the same way as we would looking back over the last 1 year, reporting year, or even previous to that. So within the rule, we got disclose in all cases, governance, risk management, risks that aligns directly to TCFD, or we've got the ones that we disclose in some cases where the company is already talking about it. So when we talk about climate risk and opportunity, these are some of the risks that organizations are starting to need to consider. So we've got the physical, that's pretty easy, right? We can all understand what our risk of having a flood is. The challenge is there's about 10 different flood models that predict all different things in terms of how often I'm going to be impacted by flood. There's sea level rise models that exist. Again, there's a number of them that exist. So the challenge, even with the rule as it's written, is it asks you very specifically to disclose the square footage of your buildings that sit in a high risk flood zone. So there's lots of elements to that short statement that's almost word for word out of the rule. One is, how do you define high risk? Which model do you use? We don't have great answers to that just yet. And we're hoping part of what we see in the final rule is better definition around some of those areas that help to bring us closer to that consistent, comparable, reliable information. Because without that, it's going to be very hard to even compare at a very basic level who is in the area of high flood risk. The other challenge we have is hurricane. Up until very, very recently, there's not good models that forecast what the intensity of hurricanes is and how that is going to change over the next 20, 30 years. We do a pretty good job of saying, where's our hurricane risk today? But anybody that lives, unfortunately I don't in Austin, but our neighbors in Houston certainly do, live in a hurricane zone. They already know they live in a hurricane area. They're seeing them increase in intensity. But being able to try and quantify that is extremely difficult for hurricanes. So there's a whole new area of study around trying to understand hurricane risk. Now it's the transition risks that become really difficult. You can interpret transition risk to be any risk that your organization is going to be at from our transition to a lower carbon economy or our transition as the environment gets warmer. Now, if we just look at the transition to the lower carbon economy, the first one that comes to mind is we are going to need regulation. But what is that regulation? We don't know. Again, we kind of wish we had a crystal ball when it comes to what regulation regulation is going to come into play. Being from Texas, we look to California and we say, what regulation is coming in California that'll likely spread across the country in some form? As we heard earlier, California is a global leader in this space. So we look to see what's happening in California and we say, if that regulation was to be across the entire nation, how would it affect the products that I sell? How would it affect how I need to report on that information? And ultimately, how would it affect my growth? And we're speaking to some industrial manufacturing companies. Companies manufacturing pumps, compressors, air conditioners, very high energy usage equipment. Are they going to still be able to sell those products? Is there going to be new technology that comes into play that says we don't need those products anymore? We've come up with something completely different. So when we're evaluating transition risk, it's all about thinking about what's possible out there in terms of these policy and legal, these technological changes, the markets, and even reputation. If I'm in an area, I'm a high emitter of emissions, do I have a reputation risk that I'm going to start to drive away my consumers? Is my consumer behavior, my core consumer behavior, going to change? So some of the logos that Brad had up there, and the logos that we're working with, companies like Mars, looking at things like circular packaging. How do they ensure that they're not utilizing single-use plastics in as many instances as possible? Because a potential risk to that organization is all of us as consumers will stop buying that product because it's a single-use plastic, and we'll go to something else. So these organizations are trying to get ahead of it, but at the same time, the rule asks us to quantify that. So how do we quantify things like that? And the way we're doing it is we're getting very friendly with our economists. And our economists have models that allow us to look at how demand changes. We're overlaying climate risks on some of these economic models to be able to see where changes are going to occur and trying to use those as mechanisms to be able to quantify the transition risk. But it's ultimately really difficult, partially because the data is not available, and we're forecasting out beyond what we've ever had to think about before in terms of these types of models. Now, I won't go through the opportunities, but they're there. You can see the opportunities that exist, and we can always balance the risk against an opportunity. In the studies we're doing, we recognize that there's maybe 20 different risks an organization may face. There's often 15 opportunities. It's often even an uneven split, 20 opportunities, 20 risks. So they truly do balance, and the opportunities really do outweigh the risks if we really go after what the opportunities are that exist. So this is an interesting kind of perspective, is that the climate is going to impact our businesses, and our businesses are going to impact our climate. So whichever way we look, the business is impacted. And that's what we have to try and understand. Over both the short term and the long term, we need to look at how is our business going to be affected and how is our business impacting the climate in terms of the emissions that we're producing that we now need to be reporting on, hopefully, as part of the SEC rule. So if we get to some of the more contentious items within the rule itself, it's this one. It's trying to understand the financial metrics and the financial disclosures looking back over the previous reporting period. Because it asks us to do some things we've never had to think about before. It's asking us to do things like understanding how much have we spent in terms of our storm recovery because of the hurricane. And that's probably a pretty simple example. But think of what is actually a climate event and what is just a regular weather occurrence. How do you split the difference there? How do you determine your revenue is impacted because you had a reputational impact because of a news article, because you're a high emitter and people are starting to move away from your products? How do you determine the revenue impact to that? So this is all really difficult to do and this becomes probably one of the most contentious areas of the proposed rule. There's approximately between 14 and 15,000 responses, comment letter responses to the SEC rule. Now, you may have seen, and I think it was on my first slide, but they've just reopened the comment period after they called it an IT glitch. I sure wouldn't want to be that IT guy right now. So they've reopened the comment period for another 2 weeks to try and ensure that they have caught all of the different items that have been requested. And they're going through that process. And they will work methodically through that process. And I'm sure based on the litigation they know is coming, they'll ensure that they do their due diligence process, or their due process in terms of reviewing each of those particular comment letters. So this is taking time. But this understanding of not only the financial metrics, but the bright line materiality, this concept that there is now a 1% bright line materiality to understand what those climate risks are. Well, that's really hard to do. It's really hard to do to audit to that level of granularity, to get your data to that level of granularity for most organizations to be able to do a 1% materiality. Now the other item is, do the investors even really care? Have we gone too far asking for a 1%? A new definition of materiality from what the SEC currently uses, and what they reference in the SEC rule itself is that they're not changing the definition of materiality, and yet they include an item that says there's a 1% bright line materiality. So obviously lots of discussion around this. And then what are the assumptions that go into all of this? So the responses as we surveyed those 14,000 responses is generally positive, generally supportive of some kind of a rule. And maybe not exactly in its current format, but there's support for it. It's not like we have resistance across the board for this particular rule. And if we look at the numbers, right, we got 50% generally supportive, and I can't see here, 29% very supportive. So we got the majority that are supportive of some kind of climate disclosure, because we know right now it's all voluntary. People pick and choose. Again, as we heard in the previous presenter, there's all these different frameworks that people are trying to manage, and their investors all want something different. One's chasing ESG scores, so they want you to report on a particular item. Somebody else has a European entity, so they're trying to figure out what they need to do in the European entity. And at the same time, there's not a lot here in the US just yet. So there is generally support, but there's challenges for all the companies, and you probably figured out some of these challenges just in the discussion so far. But disconnect between ESG goals and strategies. There's no processes in place for this just yet. There's lots of processes in place, for financial reporting, but not too many processes in place for ESG reporting or any form of climate reporting. Getting buy-in from management employees who don't even really know what this is. We're educating people as we go on what are climate risks. How do we calculate our emissions? How do we ensure that we have that consistent, comparable, reliable information around our scope 1, 2, and 3 emissions? Establishing materiality, we talked about the amount of time this takes to actually do it, and then the specificity of the information that's going to be required. And final statement is, what do you do? What are we telling companies that they need to do right now? And the first step is determine how ready they are. So understand, if you've been doing a TCFD report, are you well aligned with what's the SEC saying? Determine where you are. Second step, educate your organization. Start that education sooner rather than later in the process. Start applying existing processes and start taking the next steps on not only your greenhouse gases, because we now not only need to report scope 1, 2, and 3, we need to report the 7 different gases that make up a greenhouse gas in the reporting. So there's a lot more to it, but also the climate risk, which is probably missing off the slide there. So we'll see what happens over the next 2 or 3 months, whether we get a final rule, but kind of fingers crossed all around. And right now they're not. Right now we have a very nice website and there's nothing in the financial statement. There's no continuity between the communication that's going out. So that's what needs to start to change, is the website needs to match what the investors are seeing in terms of that 10K that's being released. Consumers are starting to go to these websites though. Right? Now, will a consumer ever go to read a financial statement? This class likely will, but the general consumer probably doesn't go to that level of reading. But provided there's alignment between the two, that would be sufficient for that. But I think we'll see that a lot more. And the companies that are not reporting anything right now almost tells you as much about the company as if they did. So I think that's a piece of the voluntary disclosure we're seeing right now, is that the companies that aren't doing it, you can probably guess what they're doing, and it's probably not very much.
Thank you. Thank you so much.